If someone has limited money to invest, how do they decide between RRSPs and TFSAs? I mean, when does it make sense to use one of them or both of them?
Your tax bracket is really what matters. So essentially, not just your tax bracket right now while you're working, but also when you're going to take the money out. So essentially, the rule is for RRSPs, you want to put money in when you're in a high tax bracket and you want to take it out in a lower tax bracket. If you're the opposite, if you're in a low tax bracket right now, I would probably lean towards the TFSAs. So higher the tax bracket, the bigger the bang for the buck. Lower tax bracket, definitely go for the TFSA, because actually investing in an RRSP when you have a lower tax bracket could bite you in the butt, because you could take it out in the future in a higher tax bracket. And that's not the dichotomy we want.
Okay, give us some examples then of the ideal person who would get an RRSP or a TFSA.
Sure. So I'll give you an example using my family. So myself, my wife, and my son work. So if we all had $1,000 to invest in an RRSP, I would probably get about $440 back as a refund. So pretty good. My wife, for the exact same $1,000 invested in her RRSP, would probably get about $280. Not bad. And my son, because he goes to school and he only works part-time, if he invested into an RRSP, he'd probably get $0 back. So obviously, you'd want someone who has $440. That's a good bang for your buck. That means RRSP is probably likely the best choice. And then, of course, it's a no-brainer that my son should not get an RRSP. He should just get a TFSA if he wants to save. And then for my wife, it is much bigger of a discussion we have to have. What's better? In her case, it's not clear-cut.
Okay. Well, people often hear about spousal RRSPs. I don't know. A lot of people don't really understand them. I'm amongst them. How do spousal RRSPs work? When does it make sense to use one of those?
So spousal RRSPs aren't nearly as important today as they were about 2 decades ago. So how it is, they were used for income splitting. So traditional family will say the husband went to work, he got the pension, he made the money. And then the problem was when they took money out, all the income would be in his hands and taxed that way. So a spousal RRSP was used to get the deduction off the higher income earning spouse, giving the assets to the younger one. The lower income. And then when they took it out, they would pay less taxes. Now, but that all changed because now we can do income splitting. So pensionable incomes, so regular pensions, RRIFs, that sort of a thing. Even if one spouse earned it all, instead of that spouse, let's say, just was getting $80,000 worth of pension income in retirement and paying quite a high tax rate, now with this income splitting rules, they could do it so it's 40-40 and a much lower tax rate. So the need for a spousal has basically gone away. It can be useful in certain circumstances, but for the most part is not a big consideration for today's families.
What do you see, just in terms of some common mistakes that people make when they're investing in RRSPs or TFSAs?
Beneficiaries and successor annuitants. So a lot of people forget to address them. So give you an example. Someone had RRSPs and they passed away and they didn't have a beneficiary. Then it would form part of the estate. They would pay tax upon death, and they'd pay another probate tax on top of that, and then it would be distributed according to the will, which, as we know, about 50% of us don't have a will, which is another level of complexity. If they were married, particularly if they're married, and they had a beneficiary and their spouse was it, and they passed away, it would just automatically roll over to the existing spouse and no tax implications, and that existing spouse could just bleed it down as they should, and then they could have their own beneficiary. In terms of TFSA, almost the same thing. You could have something called a successor annuitant if you're married. One spouse passes away, your whole amount gets given to the surviving successor annuitant. Again, no tax implication, doesn't affect their TFSA room, and then they can use it as they feel, as opposed to all these little taxable events along the way. So big mistake there. The other major mistake that we have, particularly with TFSAs, is overcontributions. A lot of people open up TFSAs in different places, at their bank, with their broker, maybe a do-it-yourself type of a thing, and they lose track of their contribution room, and they overcontribute, and the penalty is 1% of overcontribution per month. So that could be prorated 12% a year just in penalties. And you cannot rely on CRA website to tell you what your contribution room is. They are notoriously slow with that information. So people rely on that number and then they invest accordingly and then they get penalized.
Wow. Now, I mean, picking the right tax shelter, that's only half the battle, right? I mean, look at, we opened here talking about the markets at record highs, global uncertainty right now. How should people be thinking about investing today?
I mean, if you listen to my inbox, everyone would say, but just buy gold and set it and forget it. Well, but that's not what I would suggest. Essentially, you know, there's that adage. It's time in the market versus timing the market. And timing the market rarely works out on a consistent basis. So it's time in the market. So I wouldn't be worried about all these headlines, it's geopolitical risks, all-time highs. I mean, last year, I think we spoke about it. Last year, we had, 50 or so brand new all-time highs. So if you chose to cash out at the first one, you would have missed out on 49. And we saw what happened. Last year was a perfect example. Markets went up. They dropped 20 to 30% in certain markets, and then recovered. So my thoughts is if it's for long-term, obviously, you just invest it and you wait and let for compounding to take place. If it's short-term, something like a TFSA, then you have to really think about what you're investing and when you need the money. If it's for like a down payment, you want to be a lot more conservative. If it's for a car or vacation, same sort of a thing. But overall, I am not afraid to be investing in these markets. I think that any little pullbacks that we're hearing, if you're long-term, you should just buy it, and because markets tend to go in that direction, which is higher.
You are really the counter to all of the uncertainty out there when we're seeing in the markets. So, I mean, I do appreciate your calm. I do. But can RRSPs ever work against you? You know, where the tax that you pay later outweighs the tax savings. Yeah,
absolutely. Like I think that maybe 50% of people should be investing in RRSPs. I think, like as a rule of thumb, only start considering it when you're making like $55,000 to $60,000 a year of taxable income. There's so many cases where people put money in. I've done this myself when I was younger. I didn't want to pay taxes, so I put money into an RRSP and not thinking about what happens when I have to take it out. People even in the lower income bracket, they will do that, and it could really, really backfire because they'll have to take that money out when they're 71 and 72, and they can miss out on a whole bunch of income-tested government benefits just because they had RSPs, which had to turn to RIFs. So again, the rule is only put it in if you're in a very high tax bracket, take it out when you're in a low tax bracket. If not, TFSA is the way to go.
We hear you, Mark. Thank you.
Thank you.
That's Mark Ting. He's our guide to personal finance, and he's a partner at Foundation Wealth. He joins us every week at this time.